The Oval Office in crisis. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, it's a presidential panic as the Biden administration faces a critical moment. We're going to show you what's going on at the White House and why many of the experts are actually siding with the Biden administration. But when we look at the recent economic data that just hit, it suggests that as we head into the November elections, things are far worse for the president than even he thinks. Now let's over to CNBC, where he picked today's story up with a headline as Biden says U.S. economy is the world's best. Meanwhile, Trump calls it a cesspool. The data is clear. And what I want you to understand is the stakes here are extremely high, because when a sitting president is going into an election, when the economy is good, well, the odds of them getting reelected are fairly high. But going into a recession during an election, well, you can forget it. The odds are somewhere near zero. Now, before you hit the comments and vote on who you think the next president is, there's one thing that is clear. Well, the data suggests, as you're about to see, that maybe it's not on the side of the president at all. President Joe Biden is fighting to convince inflation-weary voters that the U.S. economy is healthy. And this is something that should not need convincing, because if the economy was good, then people would not have an issue with inflation. So you can already sense there's panic here as we head into November, because America has the best economy in the world, he told NBC's Today Show, laying out an argument that is central to his re-election campaign. And arguably that is true. We are perhaps the best shirt in the laundry basket here, but reality suggests is that the U.S. economy is not nearly as strong as robust as many of the political elites want us to believe. Meanwhile, America's economic standing in the world is becoming an early flashpoint on the campaign trail, where former President Donald Trump routinely depicts the United States as a commercial wasteland. We're a nation whose economy is collapsing into a cesspool of ruin, Trump said, whose supply chain is broken, whose stores are not stocked, and whose deliveries are not coming. The question now becomes is what indeed is the economic data, and why are we seeing inflation-weary consumers just struggling with the economy? Well, the answer is obvious. It's because inflation was just too much. Here we can look at the consumer price index that's shown in blue against total compensation. This is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. This is your rank and file American workers shown in red. And what you can see is starting in 2021, well, their wages were only at best keeping pace with inflation, and somewhere by late 2021, what happened? Inflation took off and total compensation started to plateau, meaning most American workers were behind the curve for 2 years. Now, what they did was they took out loans, and this is a problem because in a high interest rate market, well, that means the debt service cost is there. And that is why we're seeing these inflation-weary consumers still struggling, because even though the data suggests that they're now getting ahead, well, when you tack on all of that debt, well, they're not ahead at all, and that is a huge problem for President Biden as he tries to convince the American public that the data is turning in their favor, and in a big way. The U.S. economy is leading the way for the global economy. It's driving the global economic train. This is from Moody's chief economist, Mark Zandi. So here you see even experts are siding with the Biden administration. Even as interest rates spike, the labor market has stayed strong. In March, U.S. private companies added a whopping 184,000 jobs. According to ADP, that is the fastest employment growth the U.S. economy is seen since July of 2023. And so here you look at the labor market, which is what all the political elites are saying is key to the rebound and the future growth of the U.S. economy. And yet there seems to be something missing, because if consumers actually believed it, well, they would spend accordingly as they thought they're going to pick up more hours and higher wages and maybe even better jobs. But things are changing, and quickly. Here we can see from the Challenger report that came out today, job cuts jumped the most in March 2024 to the highest total since January 2023 on government and tech. And this is exactly what inflation-wary consumers know. They've been behind the curve. They took on a lot of debt. They're seeing the economy slow, and now they're facing job losses. This is a huge issue as U.S.-based employers announced 90,309 cuts in March, up 7% from the 84,638 cuts announced last month. Now, one of the challenges here is we're not going to see this show up immediately in the initial unemployment claims because a lot of these people will get a severance. So what you're going to have is a lagging effect as we head toward the election, where a lot of people, if they don't find another job, they're going to find themselves on the unemployment line in a big way. In the first quarter, companies announced plans to cut 257,254 jobs, down 5% from the 270,416 announced the same quarter last year, but it's up 127% from what occurred in the final quarter of 2023. So what you see is consumers know that whether jobs are at stake here, what it means is they need to start making more money, and we can help you do that in a big way. Maybe you're trading, maybe you want to trade, maybe you need to put some extra money in your pocket. Look at this as of close of business yesterday. These are two trades from both of our reports. Here you see on global X uranium on March 7th, we put our subscribers, we show them, put in this trade on $5,000. If they would have put that in, they would have made $560 in profit on our CTA report that looks at the machine positioning. What would be your first year cost? $330. How about our technical analysis report? Well, that came the day later. They'd be up 6.52% or show a 326 profit on the same trade. That means the cost at $220, money in your pocket. You know, we talk about how one trade can pay for your research for an entire year. Many of our subscribers say at least, sometimes even multiple years. Here you can see the trades right here. Uranium taking off, putting money in our subscribers' pockets, and could be in yours too. There's two ways you can do it. One is following the machine positioning. We give you an edge because we tell you when the machines are off sides, we look at historical overlay, where they're moving, we give you the early lead, so that way you can follow them, pushing you up higher. We give you videos, we give you the report, we give you everything you need to be successful. Maybe you're a technical trader, you like those things like the MACD and the RSI, but you find yourself getting in late and out early and all over the place. We add a proprietary overlay. We smooth all those data series out. We call that Momentum Time Pro. Again, we give you the videos. In fact, today alone, I gave all of our subscribers a great setup that I think is going to put even more money in their pocket. Again, one trade pays for your whole year, and that's why we give you 30 days free to make money. All my buddies only give you 7. You can't make money in 7 days, but in 30, as you see, you can pay for your year-long subscription because layoffs are going to pick up. People are going to need to make more money, and you can do that trading. And they ticked up to round out the first quarter, though below last year's levels. Many companies appear to be reverting to do more with less approach. And while technology leads to all industries so far this year, several, including energy and industrial manufacturing, are cutting more jobs this year than last. And well, if you're facing, of course, that and you need to make money trading, those links to the 30-day free trial in the description below, check them out. Because why are companies cutting? Do you think about this from an economic perspective? You think about this from the White House. The leading reason for job cuts in the first quarter was cost cutting, which accounted for 66,302 of the reductions, followed by restructuring, and another 38,619 were due to business unit or store closures. Market conditions were responsible for another 23,000, and the rest linked to bankruptcy. These are not good signs because these numbers from Challenger and Gray are rising. That is not a good trend of economic resilience. And so you start to believe that in 3 to 6 months, a lot of these people, when their severance runs out, again, if they can't find another job, well, they're going to start showing them the unemployment statistics. Doesn't bode well for the Oval Office. That's why we're saying they're in crisis mode, because U.S. initial jobless claims, we get that today, tick up to the highest since January. Again, another warning sign for the economy as initial claims increased by 9,000 to 221,000 in the week ending March 30th. Continuing claims, what we're really concerned about, did go down, but still remain elevated. They're at 1.79 million for the week ending in March 23rd. Again, the problem here is the longer people are on unemployment, well, the less spending they do, that back feeds into the economy and leads to an increasing number of layoffs. But many people know this. This is why, again, we talk about these inflation-weary consumers. They know layoffs are coming, and in a big way. Here you can see continued unemployment claims shown in blue against total compensation in red. And when we see decelerations like this in total compensation, which are primarily led by a decrease in hours worked, what we tend to see from employers is more people losing their job. And this makes sense. If you're cutting back your raises, if you're cutting back hours worked, well, you're also going to end up cutting back some employees. And sure enough, we see this trend going all the way back to the 1970s. Look at this. Total compensation declines, more people hit the unemployment line. You see it over and over and over again, suggesting that as we don't see a big turnaround in hours worked in the months to come, that we're going to see a continued uptick in continued claims, backed by the fact that many large employers are still laying off. This is dangerous news for the Biden administration. Wrong data at the wrong time, but the experts say it's great. Here you can see the other problem is the Worker Adjustment and Retraining Notification Act, or WARN. That's again suggesting that the Challenger job cuts and the WARN notices are all telling us that initial jobless claims at some point are going to spike, and the timing of this is going to be terrible. Again, depending on who you want to see in the Oval Office next, put your vote in the comments below. Love to hear that, because the stock market has made record gains over the past several months, which suggests the U.S. economy is booming, because many believe the U.S. stock market is a proxy for the U.S. economy, but really it's not, as housing values have soared, though they have now begun to decline as inventory improves. And besides sticky high prices that are projected to cool in the coming year, Zandy said the fundamentals of the U.S. economy are nearly ideal. The economy is picture perfect. It's hard to argue with it. Well, Zandy, we are arguing with it, and it certainly isn't picture perfect at all, because even though the equity markets are making new all-time highs and are, as of today, sitting right near them, when you look at total compensation, as people lose their job and hit the unemployment line, well, it means they're less likely to buy stocks. In fact, they're more likely to cash in, and history shows that when total compensation goes down, well, the stock market tends to follow. This time, we have the biggest divergence in history as total compensation continues to fall, as more and more people crowd in to what actually turns out to be about 7 stocks. So we have more people owning the Magnificent Seven than any other time we see crowded into a trade. This could end very badly. This is, again, why you need our reports, because we give you things that are deep value, that have upside potential. As it's both policy and luck, said economy Joseph Gagnon of the Peterson Institute for International Economics. In response to the economic quake of the pandemic, the U.S. government injected a whopping $4 trillion of stimulus into the economy to support individual households and businesses. And guess what, my friends? It did work, and it worked in a big way. But one of the issues, and we've talked about on the show, is it just takes time for this money to filter through. Nobody knew how long, but the problem is when it does eventually run dry, well, there's this phrase, there's going to be no skid marks as the U.S. economy hits a wall. As America's stimulus safety net came with a hefty price tag, leaving the U.S., which a much larger budget deficit than other countries, which will need to get under control. And mind you, we're starting to see this around the world now. You notice that Germany's having to start to cut their budget as their economy heads into a recession. Governments around the world, and this is going to be a big problem, who need to deficit spend to get the economy out of the next recession, are going to have no margin to do that because they went a little too far. But it also kept the economy afloat by providing a cushion so that companies did not have to execute mass layoffs. And we just talked about how that's already started, that might have spiraled into recession. Look, we're seeing the initial signs of it now. And here's some new data. Look at this from today. We talk about the services sector. Ulta, Sparks, beauty stocks rout on warning, but look at this, slowing demand. So we keep hearing how great the services sector is and how people are going to be out there spending. But here, a major beauty retailer's got problems, and they've seen both mass and prestige segments cool meaningfully from the fourth quarter. The CEO described the slowdown as a bit earlier and a bit bigger than anticipated because, well, nobody thought the economy was slowing, and called out higher credit card debt and the return late last year's student loan payments after a 3-year pause as pressuring consumers. The reality is, on top of that, total compensation growth continues to fall, meaning paychecks continue to shrink relative to inflation and debt levels. And we're surprised by the moderation. And to this point, are unclear whether this represents a shorter-term blip. Of course, this is an issue as we see the services sector demand start to decline. But it's not just the services sector. We just got some manufacturing data that everyone said, look at this, as things are turning around, that not so much as plunging pickup truck sales threaten Detroit's profit engine. So what I want you to be thinking here is if demand for Ulta is going down, and that's a proxy for other beauty retailers, and now we're going to look at the automotive, the manufacturing sector, and we see demand there go, what actually happens? Well, hours start to get cut. And then employees, it's all a cycle to the downside. As Ram pickup truck sales plunge a whopping 15% in the first quarter, driving overall sales down 10% in the period. How about sales of F-Series trucks? This is Ford's bestseller. Well, they fell 10%. This is not good. Of course, they also have problems with their F-150 Lightning due to a quality issue. And how about this? We take a look at Ram, Chrysler, Jeep, and Dodge brands. They all have inventory levels that are at least twice the industry average in February. Ram had a 101-day supply of light-duty pickups. That is wild. And of course, we talk about Ram's first quarter performance. It seems like demand issue to me more than any supply issue going on. This from an analyst at Global Data. They definitely have stock they could be selling, but they don't seem to be moving them off the lots. So again, you look at the services side, you look at the manufacturing side, and you think about now, of course, President Biden. He's got to make the case to American voters to put him back into office a second term, saying the economy is great, but underneath, the data suggests otherwise. It's strange to me that the experts suggest that perhaps the economy is booming, but we just got some trade data that says, well, that's not so great either. As U.S. trade gap widened to $68.9 billion, this is now the largest in nearly a year. But we're going to look at some underlying issues here because the deficit in goods and services trade expanded 1.9% from the prior month to $68.9 billion, the largest shortfall in nearly a year. A median estimate, of course, called for a $67.6 billion gap. The value of imports rose to almost $332 billion on gains in mobile phone, foods, and motor vehicles. Exports increased to $263 billion, reflecting shipments of civilian aircraft and crude oil. But the figures aren't adjusted for inflation, which is a problem because the headline number looks good. Just for inflation, well, not so much. And here we have the imports of goods and services less the consumer price index in blue and the export price index, again, less the consumer price index in red. And what do we know? That in periods of either recessions, as highlighted by the gray bars, or major slowdowns in the global economy, you see contractions in both. Notably, exports tend to see contractions. It's not the big deal. The issue is, look at where imports are going. The economy here for the U.S. is nowhere near as good as some of these experts are suggesting, at least not based on the data I see. And while the path of the U.S. economy's recovery is still uncertain, experts remain optimistic. We're basically on or above track where we were before the pandemic hit, so that's pretty darn good. Well, it's pretty darn good until it's pretty darn not. But weigh in the comments, what do you think? Who is our next president? What do you think of the economy? Where will things be by the time the election hits? Love to know. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.